Let me ask you something. If you're within 10 years of retirement or already retired, do you know what's happening to your purchasing power right now? Because while you've been watching your 401k statements and maybe feeling pretty good about those numbers going up, there's something else happening that most financial advisors won't tell you about, and it's eating away at your wealth faster than you probably realize. I'm talking about the silent erosion that's been accelerating over the past 4 years, the kind that doesn't show up as a loss on your brokerage statement, but shows up everywhere else: at the grocery store, at the gas pump, in your insurance premiums, in your property taxes. And here's what's really concerning. The traditional retirement playbook, the one that worked for your parents' generation, is breaking down in real time. Gold just crossed $2,850 an ounce last week. That's not just another price milestone. That's a warning signal. Because gold doesn't move like this in a vacuum. It moves when something fundamental is shifting in the financial system. And right now, if you're near retirement, you need to understand what that shift means for you specifically. Let me take you back to 2020 for a moment. Gold was trading around $1,800. Fast forward to today, and we're looking at $2,850. That's a 58% increase in less than 5 years. Now compare that to what happened to your cost of living during the same period. Your grocery bill, up 25% to 30%. Your homeowner's insurance, in some states up 40% or more. Your healthcare costs, don't even get me started. The official inflation numbers say we've seen about 20% cumulative inflation since 2020. But anyone actually living in the real economy knows those numbers don't capture what's really happening. Here's where it gets interesting. While gold was climbing 58%, the S&P 500 went up too. So you might be thinking, well, my stocks did fine, so what's the problem? But here's what most people miss. The stock market gains you're seeing are partially just keeping pace with currency debasement. When the money supply expands dramatically, asset prices go up. But that doesn't necessarily mean you're getting wealthier in real terms. You're running on a treadmill that's speeding up. And if you're near retirement, you're about to step off that treadmill. You're about to convert those paper gains into actual spending power. And that's when the reality hits. Let me tell you about something that happened in 1971. Most people don't know this story, but it's incredibly relevant right now. On August 15th, 1971, President Nixon closed the gold window. He severed the last link between the dollar and gold. At that moment, gold was fixed at $35 an ounce. Within 9 years, by 1980, gold hit $850. That's a 2,300% increase. Why? Because the market was repricing gold to reflect the true debasement of the currency that had been happening behind the scenes. Now, I'm not saying we're going to see a 2,300% move from here, but I am saying that we're in a similar repricing phase right now. And the people who understand this are positioning themselves accordingly. Central banks bought over 1,000 tons of gold last year. That's the second highest annual purchase on record. China's central bank has been buying gold for 18 consecutive months. Poland just announced they're increasing their gold reserves. These aren't emotional decisions. These are calculated moves by institutions that have access to information and analysis that most retail investors never see. Think about what central banks know that you don't. They see the debt levels. They see the unfunded liabilities. They see the political pressures to keep spending. They see the mathematical impossibility of the current trajectory. And they're buying gold. Not Bitcoin, not stocks, not bonds. Gold. The asset that has preserved wealth for 5,000 years. Now let's talk about what this means for you. Specifically if you're near retirement. You've probably got most of your wealth in 3 places: your home equity, your retirement accounts, and maybe some savings or CDs. Your home equity is denominated in dollars. Your retirement accounts are mostly in stocks and bonds, also denominated in dollars. Your savings are definitely in dollars. Do you see the pattern? You have almost complete exposure to dollar-denominated assets at the exact moment when the dollar's purchasing power is under the most pressure it's been under in decades. I want you to imagine something. Imagine you retire next year with $1 million in your 401k. Sounds pretty good, right? You've done well. You've saved diligently. But now imagine that over the next 10 years, we see the kind of inflation that erodes purchasing power by 40%. That $1 million now buys what $600,000 would have bought when you retired. You didn't lose money on paper. Your account statement might even show growth, but your lifestyle got cut by 40%. That's the invisible risk that keeps me up at night for people in your situation. Here's what's really happening right now in the gold market and why the price action we're seeing is so significant. Gold is breaking out to new all-time highs, but it's doing it in a very specific way. It's not being driven by retail investors panicking. It's being driven by institutional accumulation. The smart money, the patient money, the money that thinks in decades, not quarters, is moving into gold, and they're doing it quietly. Look at the COMEX data. Commercial traders, the big banks and institutions, have been reducing their short positions in gold. That's significant because these are the players who typically bet against gold to hedge their other positions. When they start covering those shorts, it tells you something about their outlook for the dollar and for inflation. They're essentially saying, we don't want to be betting against gold right now. Meanwhile, look at what's happening with gold ETFs. After years of outflows, we're starting to see inflows again. Not massive yet, but the trend is turning. And here's the thing about trends in the gold market. They tend to persist for years once they get going. The last major gold bull market ran from 2001 to 2011, 10 years. The current move started in 2018, and we're only 7 years in. If history is any guide, we might be in the middle innings, not the end. But here's what really concerns me for retirees and near retirees. The traditional safe haven in retirement portfolios has been bonds. You've probably heard the rule, as you get older, shift more into bonds. Bonds are supposed to be the stable, predictable part of your portfolio. But we just went through a period where bonds had their worst performance in decades. In 2022, the aggregate bond index was down over 13%. That's not supposed to happen. Bonds are supposed to protect you when stocks fall. Instead, they fell together. Why did that happen? Because inflation forced the Fed to raise interest rates dramatically, and when interest rates rise, bond prices fall. And here's the uncomfortable truth. We might not be done with that cycle. If inflation stays elevated, or comes back after a brief pause, the Fed might have to raise rates again, and your bond portfolio takes another hit. So the traditional retirement safe haven isn't as safe as it used to be. This is where gold comes into the picture in a different way than most people think about it. Most people think of gold as a speculation, something you buy hoping the price goes up. But that's not really what gold is for, especially in retirement. Gold is insurance. It's the asset that maintains its purchasing power when everything else is losing value in real terms. Let me give you a concrete example. In 1971, the median home price in the United States was about $25,000. Gold was $35 an ounce, so you could buy a median home for about 714 ounces of gold. Today, the median home price is around $420,000. Gold is $2,850 an ounce, so you can buy a median home for about 147 ounces of gold. In dollar terms, homes got way more expensive. In gold terms, they actually got cheaper. That's what I mean by gold maintaining purchasing power. Now, I want to pause here for a second because if you're sitting on $100,000 or more in retirement accounts, there's something you should know about. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's not for everyone, but if you're concerned about what we're talking about here, it's worth understanding your options. All right, back to where this is all heading. The question you're probably asking is, how high can gold go from here? And that's actually the wrong question. The right question is, how much more purchasing power erosion are we going to see in the dollar? Because gold doesn't really go up. The dollar goes down, and gold simply reflects that. Let's look at the math. The M2 money supply, which is the broadest measure of money in circulation, has increased by about 40% since 2020. That's an enormous expansion in just 5 years. Now, not all of that shows up as consumer price inflation immediately. Some of it goes into asset prices. Some of it sits in bank reserves. But eventually, that money finds its way into the real economy. And when it does, prices rise. The federal debt is now over $36 trillion. The interest payments on that debt are approaching $1 trillion per year. That's more than we spend on defense. And here's the thing. Those interest payments have to be made. They're not optional. So even if the government wanted to cut spending dramatically, they can't cut the interest payments. And as long as we're running deficits, which we are and will continue to do, that debt keeps growing. And the interest payments keep growing. It's a compounding problem. Now, there are only 3 ways to deal with that level of debt. You can grow your way out of it, which would require economic growth rates we haven't seen in decades. You can cut spending dramatically, which is politically almost impossible. Or you can inflate your way out of it, which means devaluing the currency so that the debt becomes easier to pay back in cheaper dollars. Guess which option is the path of least resistance? This is why gold is moving the way it is. The market is starting to price in the reality that inflation is going to be higher for longer than most people expect. Not necessarily the dramatic visible inflation we saw in 2021 and 2022, but a persistent, grinding inflation that slowly erodes purchasing power year after year, the kind that's hardest to protect against with traditional investments. Let me tell you about something that happened in the 1970s that's incredibly relevant now. From 1971 to 1980, we had what's called the Great Inflation. Consumer prices roughly doubled during that decade. If you were retired during that period with a fixed income, your standard of living got cut in half. But if you owned gold, you not only preserved your purchasing power, you dramatically increased it. Gold went from $35 to $850. That's the power of having an inflation hedge in your portfolio during an inflationary period. Now, we're not in the 1970s. The economy is different, the financial system is different, but the fundamental dynamics are similar. We have massive government debt. We have political pressure to keep spending. We have a central bank that has shown it will print money when the system is under stress. And we have an aging population that's going to put increasing demands on government resources through Social Security and Medicare. Here's something most people don't realize. Social Security is indexed to inflation. So as inflation goes up, Social Security payments go up. That sounds good, right? But where does that money come from? It comes from current workers' payroll taxes. And if there aren't enough current workers to cover the increased payments, which there won't be as the population ages, the government has to borrow the difference, which adds to the debt, which requires more money printing, which causes more inflation. It's a feedback loop. And if you're near retirement, you're going to be living through this feedback loop for the next 20 or 30 years. This isn't a short-term problem. This is a structural issue that's going to define the economic environment for the rest of your life. And the question is, are you positioned for it? Most retirement portfolios are built for the economic environment of the 1980s and 1990s. Falling interest rates, moderate inflation, strong stock market returns. But that environment is over. We're in a different world now. Interest rates are higher and likely to stay higher. Inflation is more persistent. Stock market valuations are stretched. The old playbook doesn't work anymore. This is why I keep coming back to gold. Not as a speculation, not as a get-rich-quick scheme, but as a fundamental component of a retirement portfolio that's built for the world we're actually living in, not the world we wish we were living in. Gold is the asset that performs when the traditional portfolio struggles. When stocks and bonds are both falling, gold tends to rise. When inflation is eroding purchasing power, gold maintains it. Let me show you something else that's happening right now that most people aren't paying attention to. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus several other countries that have joined recently, are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems, and they're accumulating gold as a neutral reserve asset. Now the dollar is still the dominant global reserve currency. That's not changing overnight. But the trend is clear. The world is slowly moving away from dollar dependence. And as that happens, the demand for dollars decreases. And when demand for dollars decreases, the value of the dollar falls. And when the value of the dollar falls, the price of gold in dollar terms rises. This is a multi-year, probably multi-decade trend. It's not something that's going to happen all at once, but it's happening. And if you're near retirement, you need to be thinking about how to position yourself for a world where the dollar is less dominant than it has been for the past 80 years. Here's another piece of the puzzle. The gold mining industry is struggling to increase production. The easy gold has been mined. New discoveries are rare. The ore grades are declining. The costs are rising. And it takes 10 to 15 years to bring a new mine into production. So even if gold prices stay high, which incentivizes more mining, the supply response is going to be slow. Meanwhile, demand is increasing. Central banks are buying. Institutional investors are allocating. And as more retail investors wake up to what's happening, they'll start buying too. Supply and demand. It's the most basic principle in economics. And right now, the setup favors higher gold prices. But here's what I really want you to understand. This isn't about trying to time the market. This isn't about trying to buy gold at the perfect moment and sell it at the top. If you're near retirement, you don't have time for that kind of speculation. What you need is protection. You need an asset that's going to preserve your purchasing power regardless of what happens with stocks, bonds, or the dollar. Think about it this way. If gold goes up another 50% from here, and you don't own any, you missed an opportunity. That's unfortunate, but it's not catastrophic. But if inflation erodes your purchasing power by 30% over the next decade, and you don't have any inflation protection in your portfolio, that is catastrophic. That changes your retirement. That forces you to cut your lifestyle. That might force you to go back to work. That's the risk you can't afford to take. This is why I'm so focused on this message for people near retirement. You're in a unique position. You've accumulated wealth over your working life. You're about to transition from accumulation to distribution. And the decisions you make right now about how to protect that wealth are going to determine your quality of life for the next 20 or 30 years. You can't afford to get this wrong. The traditional financial advice is to diversify. Stocks, bonds, real estate, maybe some cash. And that's good advice in normal times. But these aren't normal times. We're living through the largest monetary experiment in human history. We've never had this much debt. We've never had this much money printing. We've never had this level of government intervention in the economy. And we don't know how it ends. But we do know that throughout history, when governments print too much money, the currency loses value. And when the currency loses value, gold preserves wealth. I want to leave you with this thought. Your retirement isn't just about having enough money. It's about having enough purchasing power. It's about being able to maintain your lifestyle. It's about not having to worry about whether your savings are going to last. And in an environment where the currency is being systematically devalued, you need assets that protect against that devaluation. Gold is one of those assets. It's not the only one, but it's the one with 5,000 years of history proving it works. So if you're near retirement, watch gold closely. Not because you're trying to trade it, but because it's telling you something important about the economic environment you're about to retire into. It's telling you that the smart money is worried about currency debasement. It's telling you that the traditional safe havens might not be as safe as they used to be. And it's telling you that you need to think differently about how to protect your wealth. The rules have changed. Make sure your portfolio has changed with them.